If you're buying a home this year, you've probably seen listings mentioning assumable mortgage. While it sounds promising, especially with today's rates, most buyers don't know what it actually takes to assume a loan or whether it's even worth it. I'm getting more questions about assumable mortgages than ever before, and I understand why. As of mid-November 2025, the average 30-year fixed rate is around 6.34%. That's a lot higher than what sellers locked in back in 2020 and 2021 when rates dropped to historic lows, some as low as 2.65%. Buyers are looking at these numbers and wondering, can I just take over their loan? The short answer, yes, you can. But there are some conditions to keep in mind. Today, I'll show you exactly how assumable mortgages work, what you need to qualify, and what most buyers miss before they fall in love with a low-rate home. No hype, just what you need to know to avoid a costly surprise. Number 1, what is an assumable mortgage? An assumable mortgage lets you take over the seller's existing loan, same interest rate, same monthly payment, same remaining balance. That means you lock in at a rate as low as 2.75%, even when new loans are at around 6%. FHA, VA, and USDA loans are usually assumable. Conventional loans aren't. But here's the part many people miss. The seller cannot hand you their loan privately. You're taking over the rate, not skipping the approval process. That's why early in your home search, ask the seller or your real estate agent if the existing mortgage is assumable. This can become a strong negotiation point and help you plan financing accordingly. Number 2, what are the benefits of having an assumable mortgage? The biggest draw is simple. A lower rate means a lower monthly payment. A seller who locked in at 2.75% rate in 2021 may have a monthly payment that's hundreds of dollars below what a new buyer would pay at today's rates. That monthly difference adds up over time and can help a buyer qualify for more homes. Another plus, assumptions often come with fewer loan origination fees, which can reduce closing costs. Number 3, how do you qualify in 2025? As I said earlier, even though you're taking over an existing loan, you're not skipping the approval process. Lenders will check your ability to repay the loan just like they would with any new mortgage. Most lenders look for steady income, a credit score that meets minimum requirements, a debt-to-income ratio typically under 43% to 50%, proof of funds for the equity difference. Be prepared to submit the usual documents: tax returns, pay stubs, bank statements, employment verification, and identification. Tell your lender early that you're interested in assuming the loan, so you can pre-qualify for an assumption to save time once you find the right home. Just know that assumptions aren't quick. Many lenders don't process them often, so the review timeline can feel slow. Expect 45 to 90 days depending on the lender's workload. If speed is your priority, assuming a mortgage may not be ideal. Number 4, when does an assumable mortgage make sense? In the right situation, this type of loan can help you save on your home. Assumable mortgages can be a smart move if the seller's rate is far below today's rates, you have the cash to cover the equity gap, you plan to stay in the home long enough to benefit from the lower payment, monthly savings justify the upfront cost. You want potentially lower closing costs. For sellers, being able to offer an assumable loan can make their listing stand out, especially in a competitive market where buyers need relief from high payments. Assumable mortgages aren't a magic shortcut, but they can be a real advantage when everything lines up. The key is understanding the process, preparing for the equity gap, and working with professionals who understand how these transfers work. If you're looking at a home with an assumable mortgage or wondering whether your own loan could help attract more buyers, reach out for a one-on-one consultation and I'll help you break down your options. The right guidance can help you avoid surprises and decide whether an assumption is worth pursuing.